Generally accepted accounting principles, or GAAP, are the bedrock of financial reporting in the United States. They're like the rules of the road for accountants, ensuring that financial statements are accurate, consistent, and comparable across different businesses and time periods. Today, let's take a deep dive into the 10 fundamental GAAP principles, exploring what they mean, why they matter, and how they impact the world of finance. First up, we have the principle of regularity. Think of this as the commitment to follow the established accounting rules and guidelines without deviation. It's not just a suggestion, it's a requirement. Imagine an accountant at a tech startup who has just signed a multi-year contract for software development. According to GAAP, they can't just recognize all the revenue from that contract at once. They must recognize revenue as the work is completed. This principle ensures that financial statements reflect the true performance of a company over time. If everyone followed their own rules, comparing financial data across companies would be like comparing apples to oranges. The next principle is the principle of consistency. This principle emphasizes the importance of using the same accounting methods and policies over time. Once a company chooses an accounting method, such as how to calculate depreciation on its assets, it should stick with it unless there's a compelling reason to change. This consistency is crucial because it allows investors and stakeholders to compare financial statements across different periods accurately. Picture a company that starts with straight-line depreciation but suddenly switches to a declining balance method without justification. That change could mislead investors about the company's financial health. Consistency builds trust. It tells stakeholders that they can rely on the financial data being presented. Now, let's talk about the principle of sincerity. This principle is all about honesty and accuracy in financial reporting. Accountants must report the company's financial performance truthfully without embellishment or bias. If a company has had a rough year with both gains and losses, the accountant must report both sides of the story. This principle is crucial for building trust among stakeholders. If investors feel that they are being misled or that the financial reports are not sincere, they may think twice before investing. Upholding sincerity is not just about following the rules, it's about maintaining integrity in financial reporting. Next, we have the principle of permanence of methods. This principle ensures that once a company adopts a specific accounting method, it should continue using it consistently. For example, if a company decides to use the FIFO method for inventory valuation, it should stick with it in future reporting periods. This consistency allows for reliable comparisons over time. If a company switches methods arbitrarily, it can distort financial results, making it difficult for stakeholders to gauge the company's true performance. This principle helps maintain stability in financial reporting. Following that, we have the principle of non-compensation. This principle prohibits offsetting debts against assets or revenues against expenses unless explicitly allowed. It's all about transparency. For instance, if a company has $1 million in assets and $600,000 in debt, those figures must be reported separately. This clear reporting prevents misleading stakeholders about the company's financial position. Imagine if the company tried to present a net figure of $400,000 instead. That could lead investors to believe the company is in a stronger position than it really is. Next, let's explore the principle of prudence. This principle encourages accountants to be cautious in their reporting. It's about acknowledging costs and obligations when there's uncertainty while deferring the recognition of income until it's certain. For example, if a company has receivables that may not be collected, it should make provisions for doubtful debts. This conservative approach helps prevent the overstatement of financial health, ensuring that stakeholders aren't misled by overly optimistic projections. It's a safeguard against financial reporting that paints an unrealistically rosy picture. Now, let's discuss the principle of continuity, also known as the going concern concept. This principle assumes that a business will continue to operate into the foreseeable future. This assumption affects how assets and liabilities are valued. For instance, if a company owns machinery, it's valued based on its future utility rather than its liquidation value. This principle is crucial for understanding the long-term viability of a company. If there are signs that the business may not continue, accountants must reassess asset valuations, which can significantly impact financial reporting. The principle of periodicity is next on our list. This principle mandates that financial activities be recorded and reported over specific intervals, such as quarters or years. Regular reporting helps stakeholders assess a company's performance over time and make informed decisions. For example, a retail company might publish quarterly financial statements to provide a snapshot of its performance. This periodic reporting allows investors and creditors to gauge the company's financial health and make timely decisions. Now, let's talk about the principle of materiality. This principle ensures that all significant financial information is disclosed. Materiality is about determining what information could influence the decision-making process of users of financial statements. For instance, if a company has a significant lawsuit settlement, that information must be reported. This principle balances the need for transparency with the practicality of reporting, ensuring that stakeholders receive a complete picture of the company's financial health without being overwhelmed by insignificant details. Finally, we arrive at the principle of utmost good faith. This principle emphasizes the ethical responsibility of all parties involved in financial reporting to act honestly and faithfully. It's about ensuring comprehensive disclosure of all pertinent financial information, even if not explicitly required by regulations. This principle guards against misrepresentation and encourages accountants to make ethical judgment calls. It's about building trust in the financial reporting process and ensuring that stakeholders can rely on the accuracy of the information presented. In conclusion, the 10 GAAP principles are more than just rules. They form the foundation of financial reporting and ensure the integrity and reliability of financial statements. Understanding these principles is vital for anyone involved in business, from managers to investors. They promote transparency, consistency, and accountability in financial reporting, which are essential for maintaining trust in the financial markets. By adhering to these principles, accountants and financial professionals contribute to a more stable and trustworthy economic environment, ultimately benefiting everyone involved. So, the next time you look at a financial statement, remember these principles and the crucial role they play in the world of finance.